Peter Rose, Longwood Currency Trading. What's the most important mathematical equation that you should understand for your Forex trading? That's what I want to talk about today. It's mid-August of 2021. I just finished a cup of coffee, and instead of getting a cup of coffee to talk with you guys, I'm just done, and I'm gonna not have a cup of coffee because I want to get done with this video. It's a beautiful day. It's really hot out. It'll probably hit 100 today, but and that's rare for New England. But I thought I needed to get this material done without slurping through the coffee and all the rest of the stuff. So stay tuned as we move into the library to go through this stuff. Right? Okay. I hate reading from scripts. I don't script stuff. I like to talk extemporaneously because I know what I'm talking about. I don't need a script to deal with this stuff. But when I do videos that have calculations involved in them and stuff, I like to do the blog post first, so I've got an idea of the material I want to cover. So it's not going to be a very long video, and so I want to read off of the blog post some of the stuff that I wrote, because I think that keeps my thoughts focused, and it'll give you a better concept of what this is all about. So look, mathematical analysis of conditions within the Forex market are quite complex and can require the solution of differential equations and statistical models. You all know that if you've done any kind of study and research at all. But if you understand just one of those equations, very simple arithmetic division equation relationship, then you should be fine. And that's what I want to talk about, that very simple division relationship. And that equation is just the currency pair expression itself. For example, GDP USD or GBP USD. Currency pairs compare the value of one currency to another. And so writing the currency pair as GBP USD is actually a ratio between the base currency, which would be in this case the GBP, and what's called the quote currency USD. So that if you see GBP USD equals to 1.35, that means it's $1.35 quote currency USD value. Okay, we're going to understand this currency pair just a little bit differently, and I'm going to throw up I'm not going to throw up. I'm going to put up our first slide. Understanding the currency pair equation. So let's take a little more critical look at the mechanics of this equation. GBP USD is equal to 1.3500. Okay, that's the 4 decimal representation of what really is $1.35 USD. Okay, so the above equation shows that 1 pound will buy $1.35 of USD. So 1 divided by USD is equal to 1.3500. That's what the equation means. It means that if a U.S. citizen buys a product that costs 1 pound GBP, that it will cost the U.S. citizen $1.35, or 35 cents more for that same product or whatever. Now, what about if the UK citizen wants to buy $1 of USD a product? What's going to be the what's that effectively going to cost them? So we look at this next slide. So there it says 1 pound over the USD ratio is $1.35. So if you do the magic of a little bit of arithmetic there, a little algebra, you find out that it's going to cost the equivalent of 74 cents. That means the UK citizen with 74.07 pence pound GBP has a purchasing power of $1 USD. So this means we have the following situation. As you can see from that ratio, 1 divided by 7407 is equal to 135. So basically, by taking the reciprocal of the number you come up with of the pair price, you get the value of the other currency in that currency price. Okay, that just goes to make sense. All right, let's throw up the next situation here. So, well, what if the pound gets stronger and say that goes to 1.0010, 10 pips, basically. Okay, so there's the relationship up there. You divide by the same 7407, and that gets $1.3514, or 14 pips. So yikes, now the U.S. citizen, remember the pound went up 10 pips, or 10 thousandths of a dollar. So now the U.S. citizen will have to pay 14 cents more, or 0.0014 more for the same UK product that's listed for 1 pound GBP. Now that means that if the GBP strengthens over the USD, it will cost more for a person in the US to buy that UK product. Well, what happens if the pound weakens against the dollar by 10 pips? All right, so there's the relationship there. Oops, well, that caused the ratio to go down by about 13 cents USD. Well, that means that when the GBP lost value, the USD gained value over it because it takes less of the dollars to buy that same UK product. All right, let me put the next slide up. There's really, it's a pair of slides that go through this whole currency pair price variation analysis, in which I start out with a static situation where the pound and the USD are equal, and I'm going to use $10 as the basic price, starting price, because I'm going to raise and lower each one, the pound and the USD. So if I raise the price, I'm going to go from 10 to 20, and if I reduce the price, I'm going to go from 10 to 2. Okay, so the currency pair price variation analysis goes like this. In a static situation, when the pound and the USD priced at point A and then priced at point B, if the price doesn't change, then you have a static value. It's just going to be 1-1 across the board. I've got a 10 there, but it's 1-1. I'll have to change that. And then in a rising price situation, you have 3 different scenarios, right? You can raise the pound dollar from 10 to 20, and the price is going to go up. You can lower the dollar against it, and the price will go up. Or you can raise the pound and lower the dollar, and the price is going to go up. Okay, so those are the 3 scenarios when you're looking at a currency pair that can happen to affect the price going up. Now, if we look at the next slide in this, we're going to see what happens at a falling price. So if the pound goes down, then the price goes down. In other words, the pound goes from a value of 10 to 2, then the price goes down. If the USD goes up, the price is going to go down because you're dividing a larger number into a smaller number. And then in the scenario where both the pound goes down and the dollar goes up, you get another down movement. So those are the 3 scenarios in the falling price situation. So at the bottom of the slide, you can see, so what? Well, yeah, it's just simple division, and even the dimmest of folks understand that what happens when you divide a smaller number into a bigger number is that the value goes up. Yeah, so what? Well, you know, I don't know. Let's come back and look at me read off the screen here. Look, that's the problem with this whole thing at looking at currency pair pricing, right? It's so obvious. It's too obvious. It's so obvious that it's totally overlooked as one of the key components of the Forex market. The interaction of the pairs in this relationship, this ratio, reveals the entire underpinnings of the economics of market supply demand, central bank interest rate policy, large institutional order flow. All that stuff is being reflected in whether the price is going up or down between either one of the 2 currency pairs. So if you fully understand that the price differential correlation between the pairs, then you need very little actual fundamental understanding to do your trade entry analysis. In other words, you don't have to know what's going on in the countries. You don't have to understand the politics or the economics or anything like that. What you have to understand is if the price is going up, it's either because the pound's going up or the dollar's going down. And then you got to say, why is that happening? Well, maybe recently there's been all this consternation, for example, in the pound about the Brexit situation. So every time there's a cluster shit over the Brexit thing, the value of the pound goes down, and so the value of the pound dollar pair goes down. You leave that the same, and the U.S. raises its interest rates. It means you get a better deal for the dollar than you do with the pound. So the dollar goes up in relationship to the pound, and guess what happens? The pound goes down. Pound-dollar ratio goes down. So you don't have to know what it is in order to find out what the price is doing. Look at what's happening to the price. Is the price constantly going down? Why is it going down? It's either going down because the pound's getting weaker or the dollar's getting stronger, or the pound is getting weaker and the dollar's getting stronger. Okay? So now you can go look at your news reports or go to sites that talk about fundamentally what's going on in the market and try to get an idea of, hey, maybe it's non-farm payroll and the U.S. dollar just crashed because the unemployment situation went to absolute shit and everybody's unemployed now. What it enables you to do by understanding that relationship in the pair price itself is it gives you the ability to go in and look specifically at what you think might be causing that, and if you think that could continue. If you had an interest rate change, for example, that's going to continue for a long time. If you just had somebody talking about interest rates moving, that could be a very short thing. Unless it's very convincing, like if it's the Bank of England president comes out and says, "Hey, I think the next meeting we're going to raise interest rates." Well, then you pretty well figure the pound is going to go up. But all those things to do with the interest rates have to do with supply and demand. If I think one currency is going to be a better deal and it's going to go up, I'm going to buy that currency. I'm going to buy that pound-dollar pair, for example. I'm not going to sell it. I'm going to buy it. And so the fact that the interest rate indication is strong for the interest rates to increase in Britain means you're going to be a buyer, because that's a long-term thing that's going to happen. If some asshole, like this Elon Musk character gets out and goes, "I think the Fed's going to drop interest rates or something," it means nothing. You could get a spike in a 15-minute bar, but that's where the big institutions will take advantage of that, rumor and use that against you. So you have to be very careful. That's why everybody says, don't listen to the news. It doesn't mean anything. Don't listen to it. And follow it by the seat of your pants. The news is just like anything else. It's an indicator of what may happen. Now, what's going to happen? What may happen? I mean, if somebody drops a bomb on the Federal Reserve building, that could be disruptive to the U.S. economy for a little while, maybe 4 days or something, until things square away. They say, well, the U.S. is very resilient and we're not going to be affected by that. And so the pair will stabilize. But as a scalper, as a day trader, you take advantage of stuff like that. But you have to know the strength of that move. And that's why in other videos I've talked so much about taking a look at the size of the current candle in relationship to the current ATR as to whether that's like an instantaneous thing that just happened. Like if you get a big raise in a candle, you could very well end up, let's say you get this huge spike in a couple of 15-minute candles, and you think, oh, this thing is going to the moon. Well, if you wait a while, you may find that retracts. Price retracts over the next 2 or 3 candles. And so in a chart on a 15-minute period, it's just going to look like prices went up a whole bunch and then price came down a whole bunch. But if you go up a time frame to the 1 hour, all of a sudden you get a pin bar. So all of these movements are, they're fractal. You can have a large daily move. You could also have a large 15-minute move that creates a tremendous effect in the daily chart manifestation itself. Geez, I remember I did a video not long ago where there was a 137 pip pin bar in the pound dollar in 1 minute. 137 pips in 1 minute. That's up and down. So you have to be very, very careful about how you are reading price action. I think that's the reason that a lot of folks don't like the price action and they want to go to these indicator-based systems because the indicators don't lie. Well, yeah, they of course they don't lie. They're what happened in the past. They have nothing to do with what's going to happen now. But if you don't understand this basic relationship between the two pair countries and how that affects the little jiggly moves you're going to see on the chart, price action ain't going to do you any good at all. You got to learn how to trade. So instead of going to these guys that are teaching you whether trend lines and fucking bat patterns and all this other crap, what a pip is, find somebody that understands what's going on under the sheets. They don't have to be an economist to do that, and you damn sure don't want to take your currency trading from somebody who is a bank trader, because the bank traders trade for totally different purposes. They trade in a totally different way for totally different outcomes. So they can't teach you that because you don't have, well, I'm not even going to go into that. That's, I've got a whole course, or a whole seminar, not a course, but a seminar that goes over that sort of stuff. So do your study, do your due diligence. Be very wary about what the videos are talking about, because any dumbass can get on a YouTube channel and go, well, I think it's Tuesday and it's cloudy and so the Bank of England's going to reduce interest rates. Fuck him. He doesn't know what he's talking about. Okay? Somebody that writes a book has had to stop and think about it, and then they actually had to have a whole peer group look at the material that they wrote in that book to validate that it's not bullshit, and then they produce the book. The problem is that most people don't know how to teach. And so what you're reading in the book, and here's a chart pattern, this is an engulfing candle pattern, and so this is why the price went up. Well, there's much more to it than an engulfing candle pattern. So what do you rely on? Okay, boys and girls, this is the simplest thing you can rely on to keep your trading as simple as possible is to look at the pair currency ratio itself. Why is the price going up? It's either because the numerator is going down or the denominator is going up. That's why the price is going down. Okay, so think about what I've said here. Go back over the video or go to the blog post so you can kind of look at those tables of information to get a better idea of exactly how the mechanics, how the numerator and the denominator interacting together causes that price to move. And then you say, well, it's not the numerator and denominator causing price to move. It's some economic factor behind the scenes. Well, it went up. The price went up. Well, that means that the numerator, either the numerator went down or the denominator went up, or both of those happened. That's the only way that that's going to go. That's going to occur. So try to look at the simplicity of the market itself. It's not complex. The price is either going to go up or it's going to go down. Your job as a trader, whether it's a short-term day trader or it's a long-term trader, is it going to continue to go up or is it going to continue to go down? How much runway does the price action appear to be giving me for this upward movement in price? And if there's enough special juju sauce in there that's working on that upward moving price, right, then I could jump on there for 200 pips or 300 pips if I'm a long-term trader. Or I can get a good solid 20 pips and then go back in and get another 20 for the day and make 40 pips. So 4% on your money, 4% 1,000 on 40 pips. So if you start thinking about it in those terms and simplify your analytical parameters that you're looking at, you should do fine. You just have to have somebody show you how to put the little simple pieces together. All these guys that are out there, they've got all this complex stuff and the whiteboards and the circles and arrows and oh my God. I need a cup of coffee now. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.